It's been a big day of results in the financial services sector. AMP led the way, and coming up, an interview with the company's chief executive, Craig Dunn. Also reporting was insurance giant QBE, which confirmed a big fall in first half earnings. And the Australian Stock Exchange in what could be its last full year result as a monopoly. Andrew Robertson reports.
The competitors are on their way, with Hong Kong-based Chi-X set to start operations in Australia next year. For now, though, the Australian Securities Exchange is continuing to make hay while the monopoly sun is still shining.
The underlying operating result was fairly good, with growth in all key revenue lines except one, and importantly in all the key in the three main categories of cash market revenue, derivatives revenue and listings revenue.
The increase was evenly spread across those three categories. Listings and cash market, which is settlement, clearing and trading, were both up 11%. Derivatives jumped 10%. That saw total revenue up 9% to $588 million, with net profit up 5% to $328 million. The final dividend of 84 cents a share brings the full-year payout to $1.73, a rise of 5%. The 2010 financial year was one where the ASX prepared to hand over its market supervisory role to ASIC, a move completed in August. The exchange also made extensive preparations for the advent of competition with new services and a big cut in its fees. Chief Executive Robert Elstone says he's not opposed to competition, but worries Australia's market regulations are not yet ready.
What is absolutely important is that the benefits of competition, and they are there to be got, do not come at a cost of market integrity.
As an example, Mr Elston referred to what's become known as the flash crash, which occurred in the United States on May the 6th this year. Shares in financial consultancy firm Accenture fell from $40 to just 1 cent in 20 minutes as computers drove trading outside the New York Stock Exchange. As the Australian Securities Exchange unveiled a result in line with analysts' expectations, QBE Insurance was revealing the full details of a half it would rather forget. Net profit was down nearly 40% as falling interest rates on its cash and fixed income investments wiped away nearly $150 million. As he faced investors this morning, Chief Executive Frank O'Halloran did little to hide his disappointment.
It doesn't please me to stand in front of our shareholders, and I think the last time I had to stand in front of our shareholders and saying our profit was down was in 2001. I can assure you our team is absolutely determined to get the results back up to where we'd like them to be.
Net profit after tax of $488 million came on the back of a 20% increase in gross written premium to $7.6 billion. QBE's interim dividend remains the same as last year at 62 cents a share.
The problem the company has got is that the risk margins are being used to help sustain the current level of profit, and the current level of profit is under attack because global commercial premium rates continue to be soft.
QBE has consistently driven its growth through acquisitions, but Brett Bemesure sees problems ahead on that front.
Bigger and bigger the acquisitions, and their capital position is not as strong as it used to be relative to the minimum requirements. So it's increasingly difficult for them to make acquisitions that are actually going to add value to shareholders.
Shareholders, though, liked what they heard today, with QBE up more than 1% on a day when the market hardly moved.